Good morning, everyone. I guess good morning, depending on which time zone you're in. So my name is Adam Harris. I'm a chief market analyst, and I will be your speaker, trader, presenter for today. The first thing that I would like to do, please, is check that you can hear me. I'm looking, it looks as though audio is good, and I'm just going to check that my colleagues can hear me. And of course, I'm streaming as well as going through the different things. So let's just have a look and see. There we go. Okay. Welcome everyone. So again, as I said, my name is Adam and everything looks good. I'll wait and see if my colleagues are happy there. This is part of the Strategy and Focus webinar series, and the topic today is, has Bitcoin regained its mojo? I want to have a look at Bitcoin. I also want to have a look at the other cryptos as well, relevant cryptos, and we'll see how that goes. The first thing I need to do is give you a moment to digest this risk disclaimer. And while you do that, I'm going to give you some background info behind who I am, in case you don't know who I am. I'm just watching my neighbor walk two big Rottweilers down the road. So I have moved. I'm now in Herne Bay in the UK, which is very close to the cliffs of Dover, so very close to France, just across the way. It's in a much bigger house. The house is probably 5 times what it used to be. So, and I have a temporary office, so now I can look out, so there's a countryside, so there's people walking their dogs. Anyway, it's just a very different kind of lifestyle. I am a day trader. I usually trade the UK session, which overlaps with the Asia session, and then I love to trade the US session if I get a moment. And so both of those take anywhere from 30 minutes to 90 minutes maximum, and then usually I'll look at the end of day charts at about 6:30, 7 p.m. UK time, which will let me see if there's any daily setups. And so I won't necessarily get all 3 opportunities every single day, but I will usually get at least one opportunity a day on those, which is, so I trade multiple time frames. I also manage my own stocks portfolio, excuse me, and I believe that every individual on the planet should learn and acquire the skills to manage their own stocks portfolio at a minimum. So today, I think that's enough. We can kick off here. I am predominantly a technical trader, and I have learned a big chunk of my skills from Trade with Precision when I was a client of theirs 12, 13 years ago, a long time ago. So there we go. So on today's agenda, we're going to talk about the most important support and resistance levels to determine if the next 10,000 move could be higher or lower. So I'm going to show you how I would go about looking at different time frames to determine which are the key levels to pay attention to. We're going to talk about strategies to day trade and swing trade Bitcoin. The higher up you go up the time frame. So when you look at the daily and the weekly, counterintuitively, the easier it kind of gets to determine which way the market's going to go. It moves a lot slower, so you're in a position potentially for days or weeks, ideally not longer, but it is easier. It is less stressful. So we're also going to talk about how to use Fibonacci retracement levels to uncover the areas most likely to initiate corrections, and then stop loss strategies to help you stay invested and still manage volatility. So hopefully you are able to hear and see me. Everything looks good. Do we need another light? Do I need another light here? We should be. I'll just add a second light so you can see my face. Not that you need that, but there you go. Okay, so let's kick off. And I'm going to go across to the platform here, and I'm going to create, let's just go through this and have a look at these here. So we'll start off with Bitcoin, and I've got a couple of templates that I can use. So I've got, for example, just the Vantage one, which we'll use for now, which has got these automated levels, and I'm going to get rid of those. You don't need those, and it's all free stuff you can get online. So there we go. We've got the MACD, we've got price, and we also got a couple of extra things. The clock on that, I want to get rid of that one. So let's just go to the objects. Let's show all, and let's just get rid of one of these is not working. 21, 22, delete, I don't know, we'll see. Nope, okay, back into that, just clean it up a bit. There we go, nice and clean. So before we get into that, let's just talk here very quickly about cryptos in general, cryptos as an asset class. So what I mean when I say asset class, I mean when we talk about an asset class would be something such as stocks. That's a particular type of investment class of instruments that and opportunity, and it has technically these all share the same characteristics. So technically, behaviors are highly correlated, like 98% the same. For all intents and purposes, the candlesticks and support resistance levels and the way they behave are all pretty much the same. And the reason for that is that the one thing that all these things have in common is that humans have created them. Humans have even created the algos and input the commands to the algos, as well as the humans that are trading them. So there's one thing that everything has in common, every market has in common, is that it's humans engaging in them, and therefore universal human behaviors will transfer across all the different asset classes, which is the beauty of technical analysis, is that you can use it in any market. You show me anything that has a chart and that's created by humans, and I can trade it to make money. That's the good thing. The other thing that people need to be aware of is that the stock market, depending on which country you look at, has been around. Stock markets and exchanges have been around for hundreds of years, centuries, going back to the Dutch East India Company, the rice markets in China, to the 1896 Charles Dow creating the Dow Industrial Average, which was at the time the biggest companies when we were living in the industrial era. So we're talking not just decades, centuries, stocks have been around. The currency market, so now we're talking about euro dollar, although obviously currency has been around forever, but the currency market was created in 1973, thereabouts, and initially it was only exclusively between central banks and big institutions. That's it, that's all it was. And then it took more than 20 years before currencies became available. So 1996, already by that time I had a mobile phone in my hand, I had a Nokia brick, okay, in my hand at that time. For any of you that are under 30, you won't even know what that is, but unless you've seen TV shows from the 80s or 90s. And the currency markets weren't even available to us, the retail market. So basically, if you're not an institution or a hedge fund, you might be a small firm or an individual trader, you fit within the retail market. And so we're retail traders, and it wasn't available to the retail market until 1996. And even then, so when I got in, when I was learning how to trade, when I started tinkering in 2007, 2008, 2009, I paid for my first course and started actually trading in 2009. So I downloaded a demo before that, and I was tinkering around and Google search how to trade stocks, just kept coming back with learn, discover Forex trading is the thing. Forget about stocks, Forex is all there is. And even then, looking back now, it was relatively thin on the ground. So by 2007, by the time I was getting in the 2000s, in this century, currency trading was still in its infancy. And I really feel that currency trading now, today, is the best it's ever been. And actually, engaging in the markets is the best it's ever been for the following reasons. It's more competitive between brokers and banks and everyone supplying it. There's more people engaging in the markets all around the world. The retail market, which was nothing before, which was a 5% or less of the entire ecosystem. Now, depending on which asset class you're looking at, we're up to 25%. We have grown. We now have that capability of impacting the markets collectively. And so the currency markets and the spreads. So now the spreads are tighter. When we were trading not that long ago, average spread for euro dollar was 1.5 pips, up to 2.7 pips, easy. Sterling, GBP against the US dollar, 3, 4, 5, 6 pips, 6 pips to take a trade. Overnight fees were insane. You had to pay for your charting software separately, a couple of $100 a month. It was absolutely crazy. That's only sort of 10, 11, 12, 13 years ago, not that long ago. Today, you get better quality. All the technology in every area, from the exchanges to under the hood to your computer to behind the software, everything is better. It's faster, it's more accurate. Regulation has got better. So it's more honest overall in terms of execution and tracking and everything. It's incredible, and it's cheaper. And the education is better. So like, it's just ridiculous. But the reason I'm telling you this, because you might be going, well, what has that got to do with Bitcoin? I'm trying to get you to a place where you understand that if currencies are just coming out of their teens or entering into their early 20s, Bitcoin is just entering its teens in its availability. Although obviously the creation of cryptos is more than a decade, 12, 13 years old, they weren't really. It's not that long ago. It was only like 6 years ago that they really started to be introduced onto the platforms, and really only about 3 years ago that they started to gain the liquidity. So I want you to understand something, is that cryptos are still the Wild West. They're not completely regulated in all the different countries. They're not accepted just yet. They are gaining ground. They are gaining ground, but it's early days, and therefore it is the Wild West. And the Wild West means that there are lots of potential pitfalls in liquidity and execution and all kinds of different things that are still capable of happening. You need to be aware of that, because stocks in that menu of things, stocks are the calmest, most established, safest, relatively speaking. Then you get to currencies, which are getting to that point where they're becoming safer and more regulated. And then you get to cryptos. So it's a different asset class and it has different purposes. One of the things I also want you to be aware of is that because of the swings that it's had, it's become very attractive to people who love to gamble and who love to play the lottery, because they see that possibility, no matter how remote it is, of becoming wealthy. They see, of becoming wealthy overnight. They see that as attractive, and that's what attracts them. So as an asset class, cryptos have way more gamblers engaging in it, which impacts its behavior, than you have gamblers engaging in currencies and stocks. Everybody can have that potential side to them, so that's normal, but just letting you know that this is very attractive to people who would like to bet on horses and play the lottery and all that. And so it has a kind of a different type of attraction to it. It is prone to bubbles, is what I'm saying. It's prone to bubbles. So we want to be aware of that. All right, let's go and talk about identifying support and resistance levels. Okay, so when you look at Bitcoin here, you can see with the history that we have, you can see the history here. There are certain price levels that stand out, certain areas where you could see that price has had some significant impact. You can see there's even further ones down here, just to those levels. And definitely you can see a couple here acting as support and resistance. And there's another setup over here. We've got a couple of those if you want to go up there. We've even got another little setup over here. And so I'm going to talk to you about how we go about identifying those levels and how many we need. And then we can actually take all of that and we can transfer that across to other cryptos. I think it's good, we need to be aware of that. So for example, imagine that this was a stock market. Then Bitcoin would be the very first, or the granddaddy stock that got listed, which maybe back then was, I don't know, American Metal or something, if it was rail and shipping back then. Or let's just say, let's use a modern day stock like Apple. So Apple was the first stock, hypothetically speaking. It wasn't, but imagine it was. And then Ethereum would be the second one. So the Ethereum would be like Google, and then Amazon. And so you'd be building up to that. So when you talk about Ethereum and Solana and all the different ones as well, they're just obviously building up over time, and each one has its own appeal. But the reason I'm telling you this is because stocks tend to move almost as a herd. So when you've got Amazon and Apple and Netflix and Google all going up, they all tend to, generally, they are very correlated. So there's a global risk when you talk about cryptos in general. So it doesn't really matter whether you have from that perspective, whether you have your money in cryptos such as Bitcoin versus Ethereum, they both carry that global risk, which is applicable to cryptos in general. And then you might have an individual risk, which is maybe Bitcoin versus Ethereum. And actually, one of the things I do like about the differences between them is that not all the cryptos, not all of them are the same. You get silly ones, you get joke ones like Dogecoin and a few of the others. And in their own way, they're the clown version of when it comes to these types of things. And they're designed to get people to throw money at it in a way like a shiny casino slot machine. But Bitcoin and Ethereum and them ultimately do have a purpose. The belief is built about creating a global currency that's online, that's digital, that people can access from different parts of the world. So from a technical perspective, ladies and gentlemen, it is. Hold on a second. I'm just going to check with my things. It should be. Just let me quickly grab this for my colleagues. quickly just grab a screenshot. Here's my thing. There we go, just showing my colleagues that it is streaming. Yeah. Yeah, there we go. Okay, cool. All right, so so I just want to recap where we are so far. We've got different asset classes, but technical analysis allows us to trade any asset class. Cryptos are the newest, youngest, Wild West version of the latest asset class that exists out there. They haven't, actually, this is the best way to sum it up. Cryptos have not yet found their purpose. That's the best way to put it. They have not yet found their purpose. There are different cryptos that are trying to offer different services and solutions, but they haven't really found their true purpose just yet. Now, if some of you may have heard of what's called a central bank digital currency, CBDC, that means that the banks acknowledge that having some form of digital currency actually makes sense, and they'll look to offer their own ones. But regulation is going to creep up, and it's ultimately going to clamp down the number of cryptos that come up. In the same way that I can't just go necessarily and produce my own currency, paper currency, fiat currency. So I suddenly go Atom Bucks. You're going to get Atom Bucks now. You know, that would have to be backed by something like gold or some kind of a thing. It would have to have that. So I'm just trying to clarify that when we engage in this market, it's not the same as engaging in the currency markets or engaging in stocks. We need to just be aware of that. It is its own kind of beast. And that pertains to risk and risk management. Cool, so let's have a look at this. The first thing we can see here is that we've got these multiple levels here. So how do we go in and draw levels? We really only need to identify, and I'll use Ethereum as an example here. So let's use Ethereum, let's do this one. And I'm just gonna go with pure price. That's it, so pure price, and we're gonna have a look at the key levels. So when you go up higher up the time frame, it becomes easier to identify key levels. So we're talking support resistance levels now. And the way we want to do it is we don't need to identify every single level, because then we can fill out our screen with too many levels. But we do want to really identify at least 3 levels above. So in other words, the 3 most important resistance levels above us and the 3 most important support levels below us. So price is here. Okay, so we've got price here. I'm going to mark it. So that's price over there. And I want to mark the 3 most significant levels above that. And one way I might do that is create the monthly chart, look at that monthly chart, just to see if there are any obvious levels that I need to identify. And I'm going to just quickly get a color that you can see so I can draw stuff here as well. And what we want to do is the most important levels for us are price levels, are levels that price has connected with from both underneath and above. So it's treated it as both support and resistance. The reason why is logical, is that those price levels are significant to both buyers and sellers. So both buyers and sellers have acknowledged that that level is significant. So, and then very quickly, I want to just take a side note here, talk about fundamental analysis versus technical analysis. They're really both sides of the same coin. And this is something I want you to understand. Fundamental analysis and technical analysis are really both sides of the same coin. Meaning that if I'm looking at a stock, a company stock, I could be looking at the earnings report, or I could be looking at the chart. And usually the chart is really just a plot of the numbers that are in the earnings report. It's a connect the dots of that. But the difference is that you can see patterns visually. They're easier to spot on a picture than they are in the numbers. And fundamental analysts and investors and traders, they're not the same. Those are 3 different things, are looking at numbers. So they're looking at numbers and they'll go, gold is undervalued at $1,800. It should be at $2,200. So that's kind of, those are how they'll price key numbers as an example. And what's interesting about that is when the market moves, we can see those numbers show up. So all I want you to understand is that when we look at a chart, we're really looking at how price historically has reacted to fundamental prices. So a fundamental analyst may not look at a chart really, or not really do technical analysis. They'll just be looking at whether it's going up or down. And in my experience, and this is a generalization, this is a please subjective generalization, most of the people I know who are obsessed with fundamentals are terrible at technical analysis. And it isn't that they couldn't be good at technical analysis. It's not that they couldn't be good at it. It's that they don't know how to merge the two. To them, technical analysis makes no sense, and therefore they just dismiss it. But they'll look at a chart and go, oh, the market's going up or down, or the stock price has crashed, or it's booming. But they don't really know anything beyond that. So they'll be looking at the numbers, and they'll have their analysis, and they'll do certain things. The problem with this, the trap that fundamental analysts fall into, is that they really jump in only when the number's starting to get high. So they tend to chase the market. They tend to go, oh, it's getting really high. They look at the number, they see the number climbing, they jump in, and they often really will get in right at the high. So when we have a move, we have an uptrend like this. We have what's called an extension, retracement. Now we're talking strategy. Extension, retracement, sorry, extension, retracement, push, pull, push, pull. Usually what happens is you'll hear, like you've heard recently in the news the last week, S&P Dow going to all-time highs. That means that we've broken to a new high. And so what happens is usually after this, the people who've been waiting and nervous, Nellies, and panicky on the side, and fundamental analysts a lot, will jump in here. So because their brain is only thinking about new highs, new highs, new highs, they'll jump in here. And then the market will have a correction, and they'll panic because they're bought over here, and now the market's going down. They'll get out now because they think the market's going down because it broke below a certain number. The market will turn around and go up. They'll get back in here. And so they're constantly out of sync with the market. So if you're looking at an uptrend, which is made up of a low and a high and a higher low and a higher high. So you've got a low, a higher low, a high, and a higher high. Those are your 4 components of a trend. That's the minimum requirement for a trend. There is the best place to get in and the worst place to get in. So every single entry, and I'm giving you some gold nuggets here, every single entry into a trend can only be and is only on either a pullback or a breakout. So move, pull back, and then if you break to a new high, there's your breakout. Pullback, breakout, pullback, breakout. So in other words, what happens is if you had to identify that area, anywhere here is considered the pullback. That's the sweet spot, but all of this qualifies as a pullback. Once you go past that point, it becomes a breakout. So what does that mean? It means that all professional, successful traders and investors, all of them, will be using an entry that is one of these two. Somewhere in this area, they will be looking to get in. All of that is considered the best potential. All your best entries will be somewhere between the breakout, which is the very last place you can get in on a move, to the pullback, which is the earliest point you can get in, the soonest you can get in on a move. And it'll depend on your strategy or depend on your preferences. Some people spot breakouts really well. They're confident, they like them, they spot them. Some people spot pullbacks. They like the fact that the market is pulling back, they love that. And psychologically, it takes a while to get there. So an untrained, uneducated person is the opposite. They're out of sync with the market. They only think about getting in after the breakout has happened. So they start getting in here, or they get in here before the pullback that happens. So they're completely out of sync with the market. They're always getting if the one thing is the right place to get in, and after that, if everything after that is bad, that's where they're looking to get in and jump it on the markets. And they're completely out of sync. But it's usually just because they're untrained. So everything I'm mentioning here is really just due to lack of education. Lack of someone saying to you, don't do that. Somebody looking over your shoulder saying, don't do that, do this instead. So for example, here we've got an uptrend, right? Uptrend, higher lows, higher highs on the monthly. So what does that mean? It means that Bitcoin, Ethereum is in an uptrend, okay? It's in an uptrend, it's bullish. But, and I see the question coming through, thank you, let's have a look at that. Sorry, but there is really, okay, hold on a second. There's no sound. No. Okay. It should be fine. Let me know. Okay, so we have an uptrend there. We have an uptrend, but we always have to ask ourselves, that was the last breakout. So what's happening now is we're kind of potentially at that wrong point in the cycle, just to be aware of that. Here was a downtrend. So the good news is, let's clear this up, that looks like a mess. The good news is that Ethereum and at least Bitcoin are all in an uptrend now. That's a great sign. This is a monthly thing. That's one tick in the box. The market is climbing. The next thing, and it's really important that I cover this with you, is the angle of momentum. So what do I mean by that? A market can be going at a very nice pace at 45 degrees. As it goes sideways, if it goes this way, it's going in a range. In other words, it's not really going anywhere. And if it goes up very aggressively, it's a bubble. So you have a bubble. So look at this. Look how we were going sideways, and then it turned around, and then it just started going up like this. And there's a term for that. It's called parabolic. So when a market goes parabolic, when it gets that big curve like that, it's too aggressive, almost straight up, then it usually has a crash. Usually it'll come back down. So it'll come back down in line with that original thing. So it'll come back down to where kind of true value is. And true value is where everybody in general feels that, okay, it's okay to get back into the market. So it's kind of a collective thing. And this is more sustainable. So anywhere in this kind of area from about there to about there, it's trending and is sustainable. So anywhere between this area, it can keep going for a very long time. As soon as it starts to accelerate and go up here, it becomes unsustainable, meaning it's going too fast, too much, and it becomes a bubble and people panic. And so you can see the bubbles that have happened in the past. You can see this. So if we just, I'm going to unlink that so we can look at it. That was the very first bubble. This was the very first bubble. This is where you had your first few billionaires, and then it crashed and came back down here. Then it went this way, and then it went into an insane bubble here, and then kind of came back down. And then actually everybody was like, okay, no, we got it now, insane bubble. And then it actually had a deeper crash. So the reason it had a deeper crash the second time was because there was a second failed attempt here. So everyone thought that when cryptos did this, that finally this is it, this is the moment it's going to come back, it's never going to go back down again. And then it did. And then the third time they were like, okay, it definitely is coming back now. In other words, people got caught in the bubble 3 times. 3 times, not just once, not twice, but 3 times. And after that, they were just like, no more. So the good news is that that is normal in a fledgling baby developing market. Everybody keeps thinking, okay, it's established now. Now it's going to go. Everybody has the same thoughts. It's crowd behavior. And the reason why is you're on social media, you're in forums, you're chatting to your friends. You think you're only thinking in your head, well, I'm the only one who's thinking this. But 6 degrees of separation basically says, believe it or not, everybody's actually thinking the same thing. It's like one of those days where you decide, I'm going to leave, I'm going to go home today 10 minutes early to skip the traffic. And then you get in and the traffic's bad. It's because everybody or enough people had the same idea as you. You thought your idea was unique. Enough people had the same idea as you. It's the same thing. It just happens way more than we think it would. So after that, everybody was like, that's it. I've lost money 3 times. I've been burned 3 times. I am done. Very normal human behavior. So the good news with this is that that means that the likelihood of bubbles happening as you keep going is less and less. It is actually less and less. It's maturing. It's less emotional. When you're a teenager, we're very emotional. We feel everything very deeply and very passionately. And as you get older, you kind of slow down a little bit. I don't mean slow in that way. I just mean you calm down a bit. Your hormones aren't going as crazy as they were. And so it tends to calm down. And that's really what's happening. I want to point out that the good thing is that the angle of this has changed. The angle of this, if I had to put it, that was the angle going up there. And this is the angle now. It's a different thing. It's calmer. It's a little bit better. So I'm more optimistic about this as well. So what I've just told you is actually a really important piece of advice. for the implication of crypto's behavior for the next few years. The next thing I want you to understand, ladies and gentlemen, is that it's a tech stock. Cryptos are digital, technology-based. It's a tech stock in its own way. It's a type of tech stock. So it is highly correlated. We are a technology society now. In 1893, we were an industrial society. So everything was metal and concrete and manufacturing, and shipping and rail and oil. Most people don't know this, but before we had crude oil underground, not that long ago, like 120 years ago, do people know what we were using to get things around, to light stuff around? It was whale oil. So if you wonder where whaling came from, that was the industry. It wasn't just food and fats and stuff. It was the oil from whales was being used before we discovered fuel, petrol and diesel. So the point is the angle's different, and it's very important to note that. Okay, so let's just recap where we are. We've spoken about support resistance levels. We've spoken about levels that should be touched from above and below. We should only do 1 or 2 or 3 above and below, and you can adjust it. It's for you. So support resistance levels, yes, there are techniques to do it, absolutely, but it is also us. It's how do I organize this information so I spot the levels that are significant. Okay, so let's go to the weekly, for example. I like to zoom out. I just want to see if there's anything significant here. And we need a minimum of 2 touches here. So any 2 touches would define a level. We've got plenty over there. You can see we're sort of touching it over here. I think there might be a level here. Sometimes you can put a level in and then look and go and see if there's anything there. And you go, yeah, okay, there's a touch. We'll keep that. I think for now, that's enough levels. That's enough levels for now. It keeps it nice and clean. Let's look at the daily. Let's zoom out a bit here just to get it. I might, you can see even here, I'm touching that level there, and maybe there's a daily level. So possibly there's a little bit of a daily level in about this area. Maybe there's another little bit of a one down here. So you can add levels and then remove them if it gets too cluttered. And I wouldn't worry about going below the daily. I wouldn't worry about that. Going below the daily is a little bit crazy on that one. So now that we have this, let's do some analysis on it. We know, and I'll tell you what, we'll go to Bitcoin. We'll do it here. Let's look at this. Let's assess what's happening here. So it's a catch-22 as a trader, especially in the beginning. You have to learn about the history. And one of the things that's always being said is that past performance does not guarantee future performance. That's true. And from a legal perspective, no, I shouldn't do that. From a legal perspective, you have to say that. You have to. Because depending on history to repeat itself is not enough. Here's the thing, history does repeat itself. It really does. Like, that's how I make my living, is that history repeats itself. But the difference is that history doesn't repeat itself all the time. And this is where people make the mistake. They put all their money on one thing repeating itself. And that's dangerous. I will put 1% on 5 different things each, or 0.5% on 5 different moves, counting on some of them at least to repeat themselves. And that's how it goes. Some don't, most do, and I make net profit. That's trading. Here's the thing. Let's talk about the difference between investing and trading, guys. When you're investing, what you actually want is you want safety. You want guarantee. You really do, because it's time-based. You're going to wait a year, 2 years, 3 years, 4 years to make money, but it has to happen. You can't wait 5 years to not make money. So from that perspective, there are certain asset classes or instruments that do tend to be safer to put your money into. So if you're investing and you look, I just want to put the money away, I want to leave it and let it grow, then stocks and property, historically, they have a greater track record, they have a longer track record. Historically speaking, they're safer. They are more likely to safely grow your money and give you really good returns, anywhere from 10 to 60% per year. Depends on what it is, depends on luck and so on, and research and work and stuff and skill. But that's it. Those are good. Currencies, not so much. Currencies is the supply and demand of the euro against the supply and demand of the dollar. So it's two things against each other. It's not just supply and demand of Apple or iPhones. It's supply and demand of everything going on the euro, everything against the dollar. And if something happens in the US, then the euro might change their policies. So they change. They all depend on each other. Way too complex. Currencies are terrible investment vehicles. Terrible. Nobody does them as investment vehicles. They're trading vehicles. They have moves. Whether you go up or down, you can buy and sell, you can make money on the moves, but not investment vehicles. Stocks, great. They tend to go up, especially the ones in the index, so especially the indices in the strongest economies in the world. Right now, and for the next 10, 15 years, so long as right-wing extremism doesn't get into government, because there's no successful right-wing extreme authoritarian economies. There aren't. Not a single one. Not legitimately. Okay. They don't exist. So extreme authoritarian governments don't make money. They're very unsuccessful. North Korea, all of them, they struggle financially. They have to take their money, right? So whereas democratic economies do the best. So I bring that up. I'm saying that if the US, as long as the US is a democracy, it is almost certainly going to be the biggest, strongest economy for the next 15, 20 years, potentially more than that. But if it is taken over and it loses its democracy, things will change. It's not guaranteed, it's very unlikely, but it is definitely, there is a working movement to take away the democracy in the US. And they're at a breaking point now. So in November this year will be the breaking point. Okay. But this is working, absolutely be aware there are people working really hard to do that. And that will impact us all. The reason I bring this up is that the US economy is the strongest in the world. It's stronger than China. China has now shrunk to 60% of the US GDP. So China is nowhere near taking over the US, at least not for the next couple of years. And the next 8 countries are collectively combined aren't even as big as the US. So it's just massive. And so for now, and as long as it's a democracy, the US economy is the best one. The stocks are the strongest. We're using them everywhere. Everywhere you go, everybody on the planet is using Amazon, or they're using Netflix, or they're using Google, or we're all using US products. Okay. So I just want to establish that. Next thing is we have an uptrend here. And if we were talking about investing versus trading. So if you want to invest, that's what you, if you want to invest, you would look at that. If you wanted to do something that was higher risk with the potential for higher return, but it's also the potential for greater losses, you'd look at something newer, something new, like renewable energies, or say maybe something new out there. You would include in that, you would include cryptos. You would include cryptos because they're new and they're swinging wildly. Then as a trader, it's very different. So as a trade, you're looking, so what happens is the difference between an investor and a trader, or investing and trading, is that investing counts on this happening over time. So it's time-based. You just leave it, it has to go up. In other words, it just has to go that way. As a trader, we're not looking for that. We're looking for short-term things, things that will last a few hours to a few days, maybe a few weeks, maximum 3 weeks, like that's it. On average, a few days. Okay, and what happens is we look at something like this, happening like this, happening like this. We see a pullback, and we are counting on that, just that move. That's all we are doing as a trade. We get in here, we get out there. If it pulls back, we get in here, we get out there. So that's the difference between trading and investing. Trade is just a short move, and you have to get out. So if you're sitting there going, well, I can get in on a trade and then switch it to an invest, no, that's why people lose money. So to be successful in trading, you only do short moves. You can do both trading and investing, but you don't mix the strategies. That's like trying to play rugby on a football field, and soccer on a rugby field. Like they're two different sports that look the same. You've got a ball, you've got a number of players, you're on a field, goals are slightly different, rules are different outcome. You can't mix the two up. So trading is only looking for a high probability immediate move in a particular direction, and you take it just for that move. And so traders will be more successful with cryptos because they know the difference. They understand that cryptos might come down. So as a trader, you'd look at this and you go, we're in an uptrend, therefore I should generally be buying. But I'm at the worst part of the move. Here was the breakout. Now we're overextended, so I shouldn't be buying now. I should be buying, but I shouldn't be buying now. Does that make sense, guys? So it's timing now. So the trading, it's about timing. We know the direction it's going up. We've had a move, extension, pullback, extension. So we need the pullback, looking to go long. So let's recap. Overall, the trend looks better now. It's calmer. It's not going up like this in a single move. It's got beautiful rhythm to it. The heartbeat is settling in. It's calming down. It is in an uptrend. The angle looks good. This looks healthy. We also know we're in a bull market. Why does that matter? Well, cryptos tend to climb when the rest of the market is climbing. Why is that? Very simple. When the market is climbing, people are in the mood to invest money, put money in somewhere. As soon as the market's crashing, they panic, they collect all their money, and they're like, I just got to be prepared for the worst. So they don't spend as much, they don't do a whole lot of things. So we had COVID, and then we had other stuff happen. The point here is that cryptos will tend to go up when the stock market's going up, because then people are willing to put money out there. Okay. The other thing that's different is that over time, big money from here to here over time, institutions, investing firms, hedge funds have started to include cryptos into their offerings to clients. The clients are going, I've got enough money invested in real estate, or I've got too much invested in just that thing. I'm too exposed. My risk is too high. Capital, it's called capital at risk or capital investment. Capital exposure is the exact term. I've got too much capital exposure in Apple. What if something goes wrong with Apple? So I want something in Google or somewhere else. Over time, the firms are starting to add cryptos and an offering and coming up with ideas. Here's a crypto basket, you get a bit of everything, or you focus on Bitcoin, and we're going to do a Bitcoin gold thing. Like, they come up with all kinds of products to sell people. So that means that over time, it's gaining more and more legitimate money that's coming in, not just gamblers, but investors. Over time, it's going to stabilize. Okay, but it still hasn't got there yet. It still hasn't really found its purpose. So please understand that. Okay, good. So in other words, things are looking good and looking better now for cryptos, but there's still bumps in the road ahead. So let's go to the weekly. So we look at the weekly. What is the trend? Interesting, the trend is still up. How do I know that? Well, here we have an uptrend, higher lows, higher highs. Actually, here it's a consolidation, but that's okay. Then it does a breakout, and it's still coming down. Doesn't matter, we're still producing higher lows. We're coming into this area. And you'll notice that sometimes it pulls back into the blue where these moving averages are, these two moving averages, that one, and it heads out like a train. So the moving averages are going like this, and price does this. So we pull back into that area now. So we could find a move to the upside there. Right now, this is red, we're pulling back. I would like to see a green bar. That's a great way to tell me that the market tells me that buyers are returning, and then look to go. So again, even from a slightly longer term trading perspective or investing perspective, the market it's got a couple of different places it can turn around. It could turn around where it is right now, so that would be this area, or it could even come down as far as this before going up. Okay. It will potentially try. So sometimes it'll try and turn around here and then maybe fail. So you get a green candle, then you get a red candle, then it gets here, then you get a green candle, and it goes. This is normal. This is normal. So for every trader knows that when a market is pulling back, there's usually one or two different places it's going to turn at if the trend is going to continue. So we don't know for sure it's going to continue. What I can say is the US economy is doing really well. The markets, we are in a bull market. All the stocks are in a bull market. And this is trending really well. It's nice and calm. Therefore, the current weather indicates that everything is good. And remember, the markets can't keep changing all the time. It's ridiculous. It just doesn't make sense. They can't change every minute of every day, of every hour, in every direction. They do tend to fall into a trend, but then eventually the trend changes. So they do change, but just not all the time. It's not completely ridiculous. So I make a living off the fact that the market doesn't change so much that no matter what you do, you lose. Okay. So those are the two areas where I would expect this to turn around at. and it is currently in that pullback phase. That's what I'm looking for. If you go down to the daily, you have a downtrend. So we were talking a little bit about multiple time frame analysis. What does that mean? It means that in your weekly going up, your weekly trend that looks like this, that's your weekly trend. If you go down to the daily, I need to actually do this differently. So that's your weekly trend doing this, extension, pullback, extension. Your daily, it's like fractals. Your daily is doing this. And then your daily goes into a temporary downtrend, then it kind of turns around and it starts doing this. And this is the same. If that's my 4 hour, then the smaller one is my 1 hour. If this is my 1 hour, then that's my 15 minutes. So there's always patterns within patterns. And yes, your best setups are when both of you are going in the same direction. So this is going up and this one's going up. They're both going up. That's when you get your strongest probability. So right now, what's happening is because our weekly is doing a retracement and my daily is in that downtrend. For investors, and then the thing is that you should never buy in a downtrend. That's the mistake most people make. Their logic is, well, I'm an investor and it's going down, so it's cheap, so I'll get in now. And actually the reality is, the real world professional truth is that it's going down, which means you just gotta wait till it turns around. You don't get in on something just because it's cheap. You get in because it's cheap and it's going up. That's what Warren Buffett would do. Right price, but right direction. And most people don't have the patience. So when you hear about trading needing discipline, it's actually patience, but you do need discipline to be patient. So yes, question. If you have a question, please just type it into the questions box and let me know. Okay, I love it. Love the interactivity. So in this particular case, there are trading opportunities, but not investment opportunities. Does that make sense? Investment opportunity will come here or in this area when it turns around. So that'll kind of be the case. But for now, it's going down. And so traders will know that it's either going to turn here or here. And if it carries on down, they might take some short-term sells. This is very important. I'm trying to kind of give you an idea of how experienced traders will assess how safe it is for them to take a shot. Some traders will go, you know what? We could turn here. We're too close to that level. I'm not going to take any sells now. I want to see if it turns around, and then if it is, I'm getting ready to buy. So traders are really looking for, I need to just know what direction is it going in now, and how long do I have before price hits the next major level or turning point. And if there's enough room and the trend is strong, I'll take it. I'll take a chunk of that action. That's how we do it as traders. Okay, so I see somebody's put their hand up, but if you have a question, just write the question in the question box and I'll answer it. Okay, so that's really important. So just let's recap on what we're looking at. Overall, the markets are bullish, they look good. This is what's known as divergence. So let's just clear this up a bit. You can see we're creating higher highs as we go up here. So that's trending higher, but this is trending lower, which basically is how it tells you when the market is getting to this point and it gets tired, it starts slowing down, your indicator starts actually doing this. So actually you're still there, your market's still going higher, but your indicators start doing this. Basically it's worked out that the market is slowing down on the way up and it does that. So this was a clue actually that this was coming. We've broken through this level. We're probably going to head down potentially, as I said, as far as this or anywhere in this area. Okay, that's going to be how it's going to go down. And so again, here, when the markets, we have our moving averages, the black one and the blue one, they're just 20 and a 10, nothing fancy, just a 20 and a 10. And price is like a train. So the train leaves the station, comes back to the station, leaves the station, comes back to the station. I like this. This is how I identify the pullbacks. Remember, we were talking about either a pullback or a breakout. These are great for identifying pullbacks. And there's your location when you can spot when prices come back to it. Okay, you get that. Now price is underneath it. So what's going to happen here is price is potentially going to do this. Price will come back, the trend will come back to the station here and then head out. And when it's ready to turn around, so maybe when it gets here, what it's going to do is come down here and then it's just going to go straight through the train station and start coming down on the other side as it goes up. Okay, and the moving averages will turn around and it'll start bouncing off the moving averages that way. You can see it happened here. So now it's bouncing on top of the moving averages, and then it goes underneath the moving averages and so on. So that's, excuse me, strategy. All right, so let's recap again. Let's have a look at this. It looks good. We've got a strong reaction against this level, and price is busy retracing. Ethereum is the same. Ethereum also looks good, similar type of behavior. So almost exactly the same thing. Let's bring it out. Got a nice little retracement, but it's in an uptrend. Here's your high low, and it can come back down as far as this. If it comes back there and carries on, it's still strong. Looks good. Now let's have a look for reference. Let's look at the S&P. So we go across it to the S&P and look at that on the weekly. That's still trending higher. So again, if these indices are trending higher, the probabilities are that crypto should also trend higher. They are, but they're also doing a bit of a retracement. Overall, it's still looking really nice and healthy. I'm very happy with that. Overall, I'm very happy and healthy. I'm very happy with that. What's wrong with me? Woo, early start today. Okay, so that's really what I'm going to be watching for. And again, if I zoom in on this, so if I highlight this, this is an area where I expect the possibility that price will turn around. Yes, it could continue down here. I don't think it will go further than that. So I think we'd be looking at an area something like this if it was going to be the case. But if we go down to the daily, we're in a downtrend here. Let's just say that it is. Let's identify. There's that really nice crisp level there. We could turn in this area. So what would I need to see? And you can see there's another level here. So we've got that area. So we'd come down to here and turn around. So we go to the 4 hour. And what would happen here? So here's our area. And so what I would like to see is that price would begin potentially to turn around this way. And remember, I was telling you about this and the moving averages doing this. It can work the other way. So what happens is this starts slowing down, this starts climbing. So let's have a look. It's a clue. Also, again, when that divergence happens, when it starts diverging, that is not the buy or sell signal. That's not. Traders must always, this is another golden rule, traders must always wait for price to confirm what the indicators are saying. So if price is going down and the indicators are bullish, you have to wait for price to turn bullish. In other words, that's really what professional traders do. So amateur traders keep trying to anticipate what the market's going to do too soon. So it's going up, so they start selling it because they think it's got to correct. Professional traders who've learned by losing money by doing that will wait. They'll go, yes, I think the market's overbought. Yes, I think it has to turn around, but it hasn't turned around yet. And I will wait for it to change trend. And it's interesting because when you do the actual maths on it, you get in at a better place if you wait for confirmation, because often you're starting to sell here, but the market goes all the way up here, then changes trend here, and you could sell from this point. So you still get the best of it, but it's safer. So what am I waiting for here? I'm waiting to see signs of potential divergence. There's a little bit here, a little bit. It should actually be producing, this shouldn't have broken here, it should be going higher. Let's go down to that 1 hour. So now it's starting to flatten out. Look at this. So from there to there, it's starting to trend up. So there are some gentle hints, but it still has to come all the way down to here. So it's still got a long way to go. But we're in that area now where potentially can change trend. I think it still has to come down closer to the 38,000 area before it will then turn around. And that's what we're looking for. So, to answer the kind of question, which is, has Bitcoin regained its mojo? Yes, I think it has. I also think that it's not as ridiculous and bubble type of behavior as it has done in the past. But that is a danger. That we could still have a bubble form. And again, the best place for you to find that out is going to be here, because we are doing our analysis. You get the weekly videos, you get the webinars, you can always ask us to look us up. So even if the topic is the S&P and you want somebody to have a quick look at Bitcoin, ask. I will always do that for you. If we have time, I will go and look at a chart for you if we have time. Maybe some of my colleagues won't do that. Maybe they'll say, look, that's not the topic today. Sure, but I will always do that. Okay. Because what we really are covering today is, what I cover from Trade with Precision, Advantage Markets, is really how to benefit from any market move, whether it's a currency or a commodity, or whether it's an index. Commodity would be gold, wheat, cocoa, coffee, cotton. If you go back to 100 years ago, they had commodities and stocks. That's all that existed. Okay, you could buy a stock in a company or a government bond when you went to war, so you invested in the government, so it's buying stock in the government, or you bought a commodity, orange juice, pork bellies, things that people were consuming on a daily basis. Cool. And so that looks very good. You can see it's testing a little bit of a level of support where it is right now. I still think it's too soon to turn around. I think it's got to turn around here at the very least. In other words, as you been doing this for longer, you realize that the market needs to do a certain kind of a proportionate move. You just get used to proportionate moves. The market goes this far, then it does this, and you realize sometimes if it's really bullish, it does a smaller move and carries on going, and when it gets weaker, it starts doing bigger corrections. So let me draw that because that doesn't make sense the way I describe it. Markets can be very bullish and do very small retracements, very bullish, but as they get tired, they start doing deeper corrections and smaller moves and deeper corrections and smaller moves, and they start to lose their lust. And then you see your indicator starts going from bullish to bearish like that. So your indicator goes bearish because it's detected that your speed of the market is changing, even though it's still producing highs. But again, sometimes the market then consolidates and carries on up. It doesn't correct. Never breaks that level. So that's why when people short the market because of that, they lose money. So in a way, success comes from, there's a whole column of things that don't help us. Risking too much, getting in too soon, moving our stop loss, revenge trading, like it's a long list. And then there's a list of all the things you have to do to get the odds on your side. Wait for confirmation, don't overcomplicate your screen, buy in an uptrend, sell on a downtrend, don't overtrade, like all these different, like it's just a list of things you must do to keep the odds on your side, things you mustn't do to make things worse. And it's really sensitive. You can do all the things in the one column that you're supposed to do, and then maybe you do one thing on the column you're not supposed to do, and that takes away your shot at winning. And it's a journey. It takes you, depends on the individual, but most people, normal people, take a couple of years to stop doing the stuff in the bad column. That's really the part that we talk about. It's to stop doing the stuff in the bad column. Okay, so what are the things that you go, well, how do I know what's good and bad? Well, I'm telling you today, go with the trend. Wait for the pullback or a breakout. Identify support resistance levels. Those are kind of things that's how you identify where your trading opportunities are. Okay, so ladies and gentlemen, thank you very much. I was going to say we've actually arrived at the end of our webinar today. I do hope you found this instructive and useful. I think this was particularly powerful, having probably presented about 3,000 webinars now. I think there was some really good stuff in this. So I'm not bragging. I think I managed to have a great topic and the period is right to talk about it, and lots of key things that I've remembered to say to you that are important to say. So I look forward to seeing you in future webinars. If you have any questions to do with the platform or the account, I encourage you to get in touch, contact the lovely folks at Vantage Markets. They're obviously very keen to help you in any way they can. As I said, specifically to do with your accounts or with the platform issues. And then I encourage you to write down any questions you have during the week or between webinars and bring them to the webinars and ask us about that stuff. All right, we are here to provide you with experienced skills and education that you can then apply going forwards. All right, I'm going to end the stream and end the webinar, but I want to say thank you very much. It's always a pleasure, and I look forward to seeing you in future webinars. So thank you very much. Nope, stop streaming, and there we go.